CarTrade Tech Limited Q1FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Vinod Sanghi, Chairman, MD and CEO, CarTrade Tech Limited. Thank you, and over to you, sir.
Good evening, everybody, and thank you for taking the time out to attend this earnings call. It's 5 in the evening and it's quite late in the day, but thank you for that. Just want to go straight to a highlight slide, which is slide 3 on your presentations, and take out a few numbers from here. We are the number one automotive, two-wheeler, four-wheeler portal in India. We have now 180 locations, 120 automalls, and the rest are ABSHOR outlets. Number of vehicles we have auctioned is at a run rate of 1.1 million in Q1. In quarter one, we also hit 31 million unique visitors on CarTrade, Bike on our platforms. 84% of these 31 million unique visitors came organically, which is the strength and health of the company. Quarter one revenue was about 93 crores, which grew by about 47%. EBITDA was about close to 18 crores, 17.7, which grew about over 100%. And the company made a profit after tax of approximately 33 million or 3.3 crores during the year. As you know, the company is completely debt-free and has a strong cash balance of almost 1,000 crores. If you go to slide 4 in the presentation, and these are consolidated financials for 3 months ended June 22. This has got some of the key highlights which I've already talked about. 93 crores is the total income or revenue, which grew at 47%. It is last year same period of 63 crores. Having said that, last year was a COVID year, so the growth of 47% is taking that into account. Adjusted EBITDA, again, as I said, is 108 crores. It's about close to 18 crores. There has been some cost escalation on employees of about 25%, which has gone up. And if you look at, the adjusted PAT, which is, really the profit before ESOPs and before tax or tax expenses, is roughly about 8.6 crores. And if you look at PAT, which is post deferred tax and ESOP, it's about 3.3 crores. This is partly also because of the one-time ESOP cost last year, which has now come down to the levels which you see here. So the company is back to a PAT positive level. If you look at slide 5, it talks about the standalone financials of the company, which has grown by about 42% at 42 crores. Adjusted EBITDA is up by 100%, which is 8.6 crores. Adjusted PAT is about 7 crores, which is up again, double of last year. And PAT itself is 1.68 crores. So on a standalone basis as well, the company is profitable. The adjusted EBITDA margin, which is without other income, is roughly 4%. If we take the, with the other income, it goes up to about 20%. If you look at the next slide, which is the remarketing side, and the remarketing business, which is slide 6. Here itself, we've also achieved a 52% growth, which is at 51 crores. Adjusted EBITDA at 9 crores, which is again 100% growth over last year. PAT again, as I said, even the subsidiary Shriram Automall is PAT positive and at 2.8 crores versus a loss last year. And adjusted EBITDA margins roughly about 13%, which is much higher than last year, but a little lower than the previous quarter. So one thing in the financials I want to highlight is that quarter one for the company is normally a little lower than quarter 4. And I think that the accounts, reflect that. It's not, our business is not very seasonal, but there is some seasonal factors, and really quarter one in any year is normally the most mutated of or the least of the 4 quarters. So that's one direction. The other thing I want to highlight a few segmentation for you so you get a better sense of the business. When you look at the consumer group itself, which is standalone, our new vehicle business grew by about 48%. In the standalone, which is our used car media business, it grew by 187%. And now the used car media business contributes close to 16% of the consumer group revenue. The remarketing business for us, which is Shriram Automall, is completely used. And if we take that used business and we add a consumer group used business, out of our total revenue of 93 crores, roughly about 67% of our revenues is used. And the balance, of course, is new. The other cut I wanted to discuss with you is in the consumer group. Our OEM business, or the car manufacturer business, grew by 51%. In the consumer group, our dealer business grew by 76% in the quarter. And now our dealer business contributes 40% of our consumer group or our standalone revenues. The other one point I want to give out is our ABSHOR outlets have now gone to 57 across 34 cities. Last year there was a big focus on rolling out these stores. This year, in the last 2 months, we've been more focused on operations of these stores, and also looking at the processes, customer satisfaction, making sure the booking online, etc., various aspects of our used vehicle booking online or ABSHOR business in terms of operations need to be. So there's a heavy focus around that for us in the first quarter. And we continue to work heavily on our product initiatives around India as, really allowing consumers to not only research vehicles on CarVale or BikeVale or CarTrade, but also trying to complete the journey online to buy a vehicle. And we are continuously building and working with manufacturers, banks, dealers to allow that, what we call a one-click purchase on our platforms. So a lot of new product initiatives going on in the company as well. And of course, all these initiatives are built into the cost of our standalone accounts. Anisha, you want to take the next couple of slides?
Sure, Vinay. These are the slides which we've been giving quarterly consistently. This is the average monthly UVs. As Vinay did mention, our UVs for Q1 has been about 31 million, and we continue to enjoy 84% of that being organic. The rest of it just gives us growth quarter on quarter and year on year. The next slide, a very important slide for us, is the Google Trends slide. It continues to demonstrate the dominance that we have as a brand, the high recall value that CarVale and BikeVale continue to enjoy over its competition, we're head and shoulders over our competition in terms of brand value. The next slide out there, which is slide number 9, talks about the key metrics on the auction side of the business. Our listings for this quarter was about 2.7 lakhs with a 57,000 volume, which translates to about 21% of conversion. Our auction listing grew by about 28% quarter on quarter and about 92% in terms of the auction volumes that got transacted on the platform. That's about it.
Yeah, I just want to add one more thing that, as I said, the first quarter for us is a 47% growth. One should take into account that last year was COVID as well. And normally, and again, repeating, the first quarter normally is the lowest for us, for the industry as well. All the industry also had a healthy growth over last year, same period, the car industry as well, the two-wheeler industry, and that's coming from, again, a COVID base last year. So, this is what we had to say. We're happy to go into question answers, etc., and clarify any doubts you might have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Yeah. Thank you for taking the question and congratulations on good set of numbers. So I have 2 questions. Number 1 is on auction listings. So if I see the auction listings, I see a clear trend that probably Q1 and Q2 are your weak quarters and Q3 and Q4 are strong quarters. Is that correct?
That is correct, Ankan. Thank you for asking the question. That is correct. As I said, Q1 is normally the lowest, and there is some seasonality. As I said, it's not very significant, but there is some seasonality. Last year, Q1 was extremely low, also because of COVID. But generally, Q3, Q4 are better quarters for us.
Great. So is it fair to assume that we have chance of crossing 3.5 lakh volumes in Q3 and Q4 this year? Going by the numbers.
Our effort is to, of course, continuously work on more and more supply coming to the platform. But as I said, Q1 is normally a tough quarter, or there is some seasonality effect of Q1.
Sure. So my second question is, in the month of May, we read a news about one of your competitors laying off 600 employees. And so given when our balance sheet is very strong and some of our competitors who are probably cash strapped right now, so are we looking at this situation to be more aggressive and look for something, maybe acquisition or something like that, or we continue to do our work as it is? Any thought or any color on that?
No, yeah, it's a good question. And we actually continue to do our work. We feel that we've been consistent over many years on focusing on our consumer and delivering a fantastic customer experience. Very, very stable with our recruitment policies and people policies. And one of the goals we've taken this year is to create a really strong people and learning organization. I always have said one of the biggest strengths we've got is the fact that we have tremendous stability in our business for many years now. And as I said, we focus heavily on making sure our execution capabilities are strong, so we keep delivering fantastic value to our customers. And that can only be done because we have strong people policies as well.
Sure. And so, what is our...
I request you to come back in the queue, sir.
Sure. Okay.
Thank you. We have our next question from the line of Nikhil Kare from Axis Capital. Please go ahead.
Yeah, thank you for taking my question. So Vinay, my first question was on the standalone business. So you talked about that the employee costs have kind of gone up. So if you could just throw some color on that. Also in the employee cost, is there any variable pay component? So going forward, what kind of quarterly run rate should we be looking at? This is more from the standalone business.
That's a good question, Nikhil, and I think it is employee costs have gone up, and I think the first quarter is factoring increments which have gone in, which is the increase in incremental cost. If you see the March employee cost and you see the April to June employee cost, the differential is basically the increments which have come across in the business. Our employee cost mostly is not variable, so we don't see at this point a significant jump in employee costs in the next few quarters. But it has gone up, and I think it's gone up over last quarter, which is incremental differential. But also year on year gone up quite significantly, and that is, I think, the factor of just wage escalation and cost escalation of wages.
Mm-hmm. So then this is the run rate that we should be looking at.
I think that's correct.
Right. And just again on the standalone business, if I look at the other expenses, right? So putting aside the marketing expenses, the other expenses, there has been a sharp cut sequentially from 8-9 crores to around maybe 5-6 crores. So any items here, and again, do you expect that going forward there could be some normalization on these other expenses, or they should continue at these levels?
There was one specific, I'm sure you want to take it, but there was one specific entry last quarter, which is why it's not there now. And you want to start to talk about that, Anisha?
So Nikhil, as we had explained in the previous quarter call, in that 8.5 crores of cost that we saw in March, there was a provisional entry or provision for doubtful debts for about 2.4 crores, which is probably the biggest delta between that and June. Otherwise, the cost that you see in June is a good benchmark of the other expenses.
Okay, great. I'll get back in. Yeah, I'll get back in. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the call, please limit your questions to 2. Should you have a follow-up question, please rejoin the queue. Thank you. We have our next question from the line of Vijit Jain from Citi. Please go ahead.
Yes, thanks for the opportunity and congratulations.
Mr. Jain, your
Hi,
line is
Vijay.
not clear.
Yeah, hi. Is this better now?
It's better, we can hear you. Yeah.
Hi, Vinay. Hi, Nisha. Congratulations on a great set of numbers. I have two questions. One is, can you give me some outlook on your marketing plans for FY23? Is there any change in your outlook towards performance marketing? And second, your acquisition outlook, given this environment change that we are seeing for startups in general. That's my first question. And my second question is on AppSure. Now you will have had some dealerships which are nearly a year old. If you could give a sense of, what kind of volumes you're seeing in these relatively more mature dealerships, that would be great.
Sure. Vijay, this question, did you want to know about the acquisition of customers or no acquisition as in business?
Oh, no, business acquisitions, because you had those plans earlier, right?
Got it. So on the customer acquisition front on the marketing side, as you've seen on the Google Trends slide, one is our traffic is up to 31 million compared to previous year, same quarter.
Right.
And, we've seen the Google Trends slide. What's happened is when competition spends have come down, the gaps between our brand or our digital brand and them becomes more stark, and that you could saw on the Google Trends slide. And as I said, the brand has just got stronger. We feel our strength is at 85% organic traffic, and our strength is also the fact that we do a lot. The rest of the 15 is performance-based advertising, which builds the unit economics of the business the way it is. So there is really no plan to change that strategy at this point of time. That's one. The second part is the acquisition strategy. Our strength is again the 30 million customers, the millions of vehicles we auction, all the technology and software we have. We're continuously on the look for inorganic opportunities so that we can augment additional services to the same amount of customers. There's nothing at a level where we can come out and say that we've done doing it or we've done it, but we're continuously on the lookout for opportunities. In every adjacency in the ecosystem, in the automotive ecosystem. So that's part of our daily job now. We're sitting with cash, as you all know, and the idea is to use that cash for such opportunities. It's just that we haven't found something yet to talk about, but we're continuously looking out for this. On the AppSure side, as I said earlier, we rolled out the 57 outlets and 34 locations. The intent here is to now just focus heavily on the operations of these locations, which is really about 2-3 different things. One is when you come online, a car and look for an AppSure car and you find it, how is the buying experience, which is the tech interface or the technology interface, or the car quality itself, the certification product itself, the money back guarantee itself. So we are heavily focused on the operation side of the business versus last year where we're looking at the rollout of the business. The second thing, we focus on every store location, what the volume per store is, the viability of franchisees, the viability of ours out there. So these are the things which we are heavily focused on. Our first goal here is to make sure that the customer level of customer experience. In fact, many of you expressed doubts about 6 to 8 months ago, where if we chose a franchise model to deliver this whole one-click used car buying experience, and then you had doubts, we don't control the entire experience. Can you deliver a fantastic customer experience? So we feel pretty confident now that the AppSure model delivers a fabulous customer experience, and I think that's the biggest, I would say, achievement for us over the last few months.
Correct. Thanks, Vinay. Now, just one follow-up question, if I can. At the start of this call, you gave some cuts of revenue, and I'm not sure I got all of them. So just confirming some of these numbers, if I can. You talked about the consumer business, and you said new vehicle business is up 48%, and new car media is up 107%. Did I get that right?
I said the new vehicle business up 48%. I said the OEM business grew by 51%. Our overall dealer business in the consumer group used and new grew by 76%. And if you count Shriram Automall, our total used business, which is our media used as well as Shriram Automall, is 67% of our total revenues. And which is because the used media side, which is just B2C, it grew by 187% and is 16% of our revenues.
Got it. Thanks. Those are my questions. I'll jump back in the queue.
Sure.
Thank you. Next in line is Mr. Siddhartha Bera from Nomura. Please go ahead.
Hi, sir. Thanks for the opportunity.
Hi, Siddharth.
My first question is again on the standalone part of your business. So in terms of the new car ad spend, so we have started seeing in terms of supplies normalizing and the production picking up from the OEM. So just because this quarter obviously had an impact of base where the growth is sort of only not correct, but just from your perspective, how to look at the revenue ramp up from here, given that now things are pretty back to normal levels?
So the car, I'm talking about the car industry. The car industry sold in the last quarter 910,000 vehicles, which is similar to quarter four. I think you're right. The fact that supply chain seems to be getting better, semiconductor seems to be getting better. I don't think it's fully recovered, but probably over the next, I think people are saying over the next 3 to 6 months, supply constraints. Supply should be available. This definitely helps us. So if we see that supply chain getting better, or we see supply getting better, it's definitely a benefit to our business on the new car side. So we're hopeful that happens. It's been actually last year for the industry, it's been pretty hard. The first quarter last year was only 640,000, and then 740,000. So getting this 900,000, it takes you up to almost the car industry roughly to about 3.6 million rate is pretty healthy, and we're hoping that this escalates even further in quarter 3, quarter 4.
Got it. So in terms of numbers, would it be possible to highlight that given the improved traction now, 20% plus type of growth run rate we probably can do going ahead on a sustainable basis, or do you think that that's too early to comment right now?
Sorry, I didn't get the number, the percentage.
20. So 20% plus.
Are you talking about the car industry?
No. In terms of our sort of revenue traction in terms of the standalone business.
20%. We got 20% of the question. Yeah, we feel pretty confident. We would like it to go by 20%. Yeah, I think so. Considering a 47% growth in the first quarter, I think we definitely like it to grow by 20%.
Got it. And the second is on the margin side. So, we have seen a couple of costs remaining largely stable in the last couple of quarters, except this employee. So now with the revenues ramping up, by how soon can we expect to touch that double-digit margins which we used to probably have sometime in the past?
We feel like the first quarter, normally what happens is that your cost build-in of increments are happening. But the revenue, if you see, is 10 crores lower than the previous quarter, which is quarter 4 last year. The moment we get back to that level of rate, we'll get back to the margin side, right? I think it's pretty, because we don't see costs increasing in proportion to the revenue increase in the next few quarters.
Got it. I'll come back to it.
Sure.
Thank you. Participants are requested to press star and 1 to ask a question. We have our next question from the line of Sachin Dixit from JM Financial. Please go ahead.
Even congratulations on a great set of numbers.
Thank you.
I had a couple of questions. The first one is, like I was saying, that Appsure business has been in operation for some time now. Is it possible for you to lay out a quick used car landscape? How are the used car sales tracking? And if, between the inventory-led models and the franchisee models, which was the initial debate when you launched this business, how are the different models tracking? Are you seeing franchisee models ramping up faster, inventory-led models getting stuck with cash becoming critical?
So we've of course never had an inventory-led model. The company stayed asset light. We find that when you run a franchise-driven model and the inventory is held by the franchisee, or the infrastructure is held by the franchisee, it definitely scales faster. I think the big challenge was not whether it scales faster. The big challenge was whether you can deliver the same customer experience by not owning the whole stack, which is the inventory, the physical infrastructure, and everything. We said we'll own the product, right? Which is we'll own the technology, the software which enables people to book online. We'll own the certification product, the money back guarantee, and all of it. but we not own the inventory if possible or the infrastructure because it just scales much faster. And we feel that's been working because the one thing, as I said earlier, we've validated is the customer experience is actually excellent, irrespective whether we own the vehicle or the franchisee owns the vehicle. So we obviously believe that not only does the business scale faster, it also has a fantastic unit economics because we are completely asset light. There are many people who are putting in inventory-driven models, and they believe they want to own or control the entire experience. I think the challenge for them will always be, when you want to own everything, one is you're competing with every dealer in India. And the second thing is, how do you make your unit economics work? And how do you roll out fast enough? Because you've got to put up every location yourself. You've got to buy every vehicle yourself. So I think their challenges are that, but they'll believe that, they can have a superior customer experience. We don't believe that, but that is where these two models are, against each other. One thing I want to highlight here, the Indian car market or the used car market is close to 5-6 million and growing over the next 5 years. So it's possible that you might have both running, right? We might have a very successful franchise model. Others may have a reasonably successful full stack model. I think we're all a fragment of the market and the opportunity is huge. So one should not think that only one will succeed or two will succeed. There may be many which may be successful.
Got it. Just a small follow-up on the same piece. Like I understood that we were planning to liquidate all the inventory that was on our books as of March 22, but we still continue to see some inventory cost in the current P&L of like roughly 2.5 crore. So can you explain how is that coming or how the business model is shaping up?
Anisha, you want to highlight that? But I think there's this insignificant pilots we keep doing. But Anisha, you want to talk about it?
Yeah, sure. So Sachin, the amount you see, if you look at the standalone entity, the purchase of stock in this quarter is only 10 lakhs. So the number you're seeing is along with the change in inventory, which is why it looks like a 2.5 number. It's a small number now in Q1.
Okay, but we'll continue to purchase some inventory, like intermittently only.
So in the standalone entity under the Apsho model, we have fizzled it out. We don't have any more purchase of stock. I think you'll have to refer to the standalone entity, the caption purchase of stock and trade, which in March was about 2.7 crores for the quarter, which has come down to about 10 lakhs in that quarter.
Okay, sure. Thanks.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have our next question from the line of Rahul Ranade from Goldman Sachs Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a few questions from my side. Hi, Vin. So on the remarketing slide, if I was just look at numbers from a March quarter to June quarter perspective for the expenses, broadly they've remained flat, right? Employee cost is the same, marketing is the same, other expenses are the same. So is there no element of variable cost built into the model as such, and that's why we've seen the EBITDA margin drop to, let's say, 18 versus 33? Is that a fair understanding?
Yeah, the variable elements are very small. I think it's not completely correlated when revenue jumps up in a quarter. If you see 60 crores the previous quarter and 51 crores now, it's not necessary that costs jump in the same proportion. I think what you see over the last year same period is 30% up on manpower cost. I think that's coming from increments this year, increments last year. And last year, as I said, because of COVID, there was a lot of cost reduction across the board, which was taking place. And I think, but I would tend to say that the variable elements are limited, very limited, across businesses. That is one of our strengths, actually.
Okay. And just, looking at console numbers, just wanted to understand the finance cost better. Actually, like, let's say, for the full year, it amounted to, let's say, 6.5 crores last year. What does this pertain to? Is this, purely bank charges, etc., or, because I don't understand why we need to, kind of borrow, right?
No, we don't borrow. I think this is an Ind AS accounting standard for. Anisha will explain this out.
Yes, round one, I think you're referring to the depreciation. So finance cost is about 1.85 crores for the quarter and 6.5 for the year. That is purely on account of India's accounting for the lease. We don't have any debt in the company. There are no finance charges or bank charges.
Yeah, I was referring to the 6.5 crore number for FY23. You're right. So that is largely just from the India's accounting.
Yeah.
Sure. And lastly, just on the Absure side of it, like the initial stores that we would have opened, are any of those stores, kind of in your view, reached a maturity stage, or are they still ramping up? And if they, any of the stores have reached maturity, just wanted to understand the throughput in terms of number of vehicles, where are they in terms of break even, just broad sense on that would be helpful.
Sure. The oldest outlet must be a year and maybe 15 months old. And of course, those have reached, those are far more stable in terms of the volumes. The hardest are the ones which are in 0 to 4 months or 0 to 3 months, where it's going to start. The volume is going to start from zero. And I think the challenge there is buying a vehicle and then stocking it and then selling. So it's a process by itself. It's almost like a 60-day cycle itself to buy a vehicle, refurbish and sell it. But the older ones are more stable and doing better, and also are the ones where we get confidence from on all elements, which is the whole process of certification, warranties, the dealer viability, our viability. One of the things we've been focused on when we appoint dealers is keeping their costs frugal. So we know that their rental costs or their manpower costs are frugal, so that we can make sure that the dealer makes money. For us, dealer viability or franchisee viability is as important as anything else. I would say 2 pillars which we focus on are customer experience on purchase of vehicle and dealer viability. These are the top 2 things which we feel are really going to dictate the success of this model.
So would it be fair to say that the initial outlets are, kind of at break even now?
Yeah. Many of them will be profitable. We, in fact, now in our monthly reviews, we calculate or we review a dealer profitability chart for all dealers. So the initial one will be profitable. As I said, again, there'll be some profitable, some, getting to profitability, but we feel pretty comfortable on it on the initial ones.
Okay. And sorry, just for my understanding, so
I request you to come back in the queue.
Sure. Yeah.
Thank you.
Thank you, Rahul.
A reminder to participants to press star and 1 to ask a question. We have a question from the line of Sagar Pare from One Up Finance. Please go ahead.
Hi Vinay, thanks for taking my questions. A few questions actually. So firstly on the standalone business, so if I look at sequentially, the monthly average unique visitors has actually gone up from 30 million to about 31 million, right? So but on a sequential basis, the revenues have kind of gone down by 5%. So just wanted to get your sense on this. So if does that mean that they are not getting converted or something, or the ad revenues are not up to the mark as, or there is no correlation between the two?
No, there is not much correlation. You're talking about Q4 and Q1 this year.
Yeah, correct.
And Q1 this year.
Yeah.
The Q4 normally, part of our revenues in the standalone business come from manufacturers and dealers spending more money on us, and that's completely coming from their budgets, their volumes, their sales, right? So I think it's a factor of all of that. In fact, if you see the business, the standalone business, normally you'd find from quarter 4 to quarter 1 there's a drop. This time actually, you find in the standalone that from Q4 to Q1, there's been a very marginal, there's been about 8-9% drop, right? 42 crores and 46 crores.
No, so if I include the other income, so I'm just looking at the...
Yeah, even if you look at 34.8 and 36.4.
Correct, yeah.
So even that is about 7-8% fall. Normally be much more steeper between Q4 and Q1. There's been a better Q1 for that business. But the traffic and this are not very correlated, is what I would say.
The bulk of the revenues, yeah, go ahead, sorry.
The traffic, is the revenues are dependent a lot on what manufacturers and dealers spend.
Okay, got it. So basically, the bulk of the revenues in standalone would be largely dealer-driven subscription kind of revenue.
As I said earlier, 40% of it is dealer-driven.
Okay.
50% comes from manufacturers.
So when you say manufacturers, it's still so manufacturers is also subscription-driven only, right?
No. Manufacturers could spend on leads, it could spend on advertising, Some are even conversion-based models. So manufacturers have different buckets. Dealers would be leads or subscription.
Okay, got it. And my next question is on the remarketing business. Obviously the numbers, volumes are sequentially have fallen, and you are alluding to the thing that it's more seasonal in nature. But if I look at your average take rates, it has actually improved sequentially. So what is your sense on how should we think of the commission per car? So it's like 8,400 for the quarter. Versus, let's say, last 2-3 quarters, it's averaged about 7,500.
Yeah, there is a seasonal fact. I think the take rate is just more a mix. I think one of the things we focused on is heavily, where our take rate is slightly better on our retail inventory. Shriram Automall has two distinct inventory supply sources. One is from corporates and big businesses with big vehicles in, and the second is from small, users, which is what we call retail. And retail tends to be higher in margin for us. And there's a little bit of a mix in the sense, a little bit of higher growth level in what we call our retail business there.
Okay, got it. My last question is on the offshore business. So what is the, can you give some color on the absolute revenues? I know it's insignificant, but broadly if you can just...
It is insignificant. It's insignificant actually, I'll be honest, right now our full focus there is not revenue. It is really about, as I said, customer experience and franchise viability. Because we feel if we plug two things in, we can scale very quickly out there. Both are correlated in the manner. So we've actually not gone out, and it's not a big focus area for us right now. Just trying to get the whole technology, the product, the customer, as I said again, the certification product, the money back guarantees, the dealer viability, the rollout of the stores. I think we're still at that. It's only a 12 to 14-month-old business, where the first 3-4 months is spent on experimentation, etc., etc. It's far more stable now. But it'll take us another quarter or 2 quarters to focus on revenues and margins, etc., etc.
But it's classified in the standalone business, right?
It's in the standalone. It is in the standalone, that's correct.
And just the commission that you charge per car is reflected as revenues, or it's the actual value?
No, it's commission per car.
Okay, got it. Okay, great. Thanks, Vinay, for taking my question.
No worries. Thank you.
Thank you. For any further questions, participants are requested to press star and 1. We have our next question from the line of Bhargava Parni from MK Global. Please go ahead.
Yeah. Hi, sir. Congrats on a great set of numbers. Just wanted to know how has the manufacturer and dealer spending been in this quarter? Like, is the trend showing upward given that the last year was a COVID year and manufacturers and dealers were not spending much on their getting leads and all? So how has that trend been? I'll come back to the second question, but for now.
Yeah, the OEM business, as I said earlier in the call, in this quarter grew by 51%. So it's been a positive trend. One would debate whether it could be better, but it grew by 51%. We feel that when supply chain is an issue and supply is an issue, manufacturers, anybody would spend less money on advertising. So if a particular product has a shortage, it's hard to convince manufacturers to spend money on it and advertise it. So that becomes a challenge. But in spite of that, it's about 51%. As we said earlier on the call, as supply eases up over the next few quarters, it actually helps our business because manufacturers need to spend then more money to sell that product. So it's actually how it works.
Right. On the average, vehicles that have been sold by maybe Appshore. So just wanted to know what is your level of comfort where you want like a per month basis, how many vehicles do you want for your comfort so that it's good for the business, like 10 vehicles per month or something on that front. Anything that you have looked at?
Sure. Our intent, as we said earlier, this year is to go to 100 locations, and we're from 57 now. And ideally, you're right. I think the average viability for a dealer with 10-15. I mean, in India, normally used car dealers have a volume of 15-20 cars per month. And our intent is to between 10 and 15 to 20 cars is the volume where these dealers tend to operate with. So I think that's how we would think about it. Build a very strong foundation this year with maybe 100 locations and in between 10 to 20 vehicles per outlet, which is really making sure that they're viable.
Right. And thirdly, in the Android business, so how much was the revenue from valuation and inspection business? Any number?
Anisha, is that you got the number?
For the quarter, it's about 4.6 crores.
Sorry? You're not
4.6 crores in the quarter.
Yeah. Thank you, sir. That was very helpful. Thank you.
Thank you. Participants are requested to press star and 1 to ask a question. We have our next question from the line of Vijit Jain from Citi. Please go ahead.
Yeah, thank you for the opportunity. Just
Hi,
a couple of... Hi. So, my question is on, there's been a few new vehicle launches from...
Mr. Jain, there's some disturbance coming from your line.
There's a hit on your phone, I think.
Oh, is it better now?
A little better. You can go ahead.
Okay. So I was just asking about, there have been some new launches from a bunch of OEMs recently. There are OEMs like Citroën, etc. And even Maruti has launched a new SUV. So I'm just wondering, are you seeing any increase in engagement from new OEMs especially, and also from established OEMs as they take a fresh look at where they spend the marketing budget on?
We definitely are seeing across established or new OEMs a general view to digital. I mean, or let's say a different or focus towards digital. I mean, without doubt, whether it's Citroën or whether it is any established player. So that's clear. I think one of the factors is that you're seeing lots of launches coming out this year and the next year, because for 2 years with COVID, a lot of manufacturers have had, obviously not been able to do it. So that should help us. I think when you have new launches coming out, it does help us, and we're hoping that over the next 2, 3, 4 quarters that will start happening. But there is definite interest, whether more from new, maybe less from established. But the drive towards digital is definitely can be seen, and that's some of the 51% growth rate of OEMs.
Great. Okay, great. Thank you.
Thank you. A reminder to participants to press star and 1 on their phone to ask a question. We have our next question from the line of Nikhil Kare from Axis Capital. Please go ahead.
Yeah, thanks. So a couple of questions on the remarketing business. So just going back to the average commission per vehicle on the remarketing side. I think typically just wanted to understand that the QOQ increase, is that also a function of, say, higher value-added services? I remember you mentioning that last year the parking charges, which are recent, that was kind of...
So your voice is breaking. We're not able to hear you.
Yeah, is it better now?
Is increase in take rate because of value-added services? Is what you said.
Yeah. So has the parking charges also kind of normalized now? Are you seeing more options kind of happening?
I think there is a good point, and it is a little better because if you look at last year's margins and this year, where you had COVID, the physical aspects of many of the things we could not do. It was mostly completely online and digital. When COVID's gone back, I think we can provide a lot more physical services to customers, and therefore take rates do go up. But I would think that the fact of here is that it's a range. 7,500 and 8,000 orders is not that much difference. It's really in this range. I would still bet that the focus we've got is not that the take rate is going up, but really the focus is how to increase conversion ratios and increase volume. That's the focus we have. I think the second thing here to note is the value-added service we talk about. Many of them are not kicked in yet. It'll take maybe some more time. Whether it is documentation servicing, financing for dealers. Some of these things will take some time. So most of this is just a little bit of product mix differential or a little more physical services because COVID is gone. COVID is not impacted now. Once it's gone, it's not impacted us here this quarter.
Got it. And just lastly, even in the remarketing business, there is some purchase of stock and trade worth around 1.2 CR. So what is that pertaining to?
They had done a small experiment, which is what the result of that is. It's very insignificant when they were just experimenting. I think in all our businesses we try and do some level of experimentation, which just to understand some models, etc.
Okay, got it. Thank you.
Thank you. We have our next question from the line of Karthi from Suyash Advisors. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. Couple of things. One is in terms of take rates. You mentioned that retail tends to be more profitable than CarTrade. I'm also curious whether the vehicle mix makes a difference, and could you share the vehicle mix for the quarter in terms of auctions?
Yeah, what definitely matters is the biggest suppliers. Obviously, the margins are lower. Number one, the more online and less physical, also margins are lower. Obviously, when you have physical services as well as an online sales, those margins are better. So I think, and then the third is, if you have supply coming from single users, that's obviously the highest margin. We've had in the business, one of our biggest focus areas in Shriram Automall is to bring more single user supply. It's roughly, as I said, 20-25% of our supply today. But that is the focus. Of the 1.2 million vehicles, roughly 20-25% come single users. So it is a big focus area for us, and that does help in margins. When you look at product mix, clearly CVs, a commercial vehicle, which is 20-25% of our volume, is also slightly better margins. But I would say, and again I'm coming back, the focus is not on take rate and margin. The focus really is on changing this 21% conversion rate and bringing that upwards, or increasing the volume of vehicle auction.
The second question is on your Absure stores. I know it's early days, but if you had to give us a break-even volume number, monthly basis for the franchisee, beyond which, of course, it becomes interesting. And how soon can does one get there?
You mean for the
yes, I'm talking about yes.
And you mean our break-even or the franchisee's break-even?
I meant the franchisee's break-even.
I think a franchisee that central vehicles a month will break even. That's typical to, and part of this dictated by the cost of real estate, right? Because the franchisee is going to take on a place. It comes from there, but normally a used car dealer with central vehicles a month that breaks even at that volume. But as I said again, if for many of them who own properties and don't rent or lease properties, it could be even lower than that. It's a question of what the rental cost or the premises cost is.
Right. And for you, what would be an interesting volume number? Would 20 be an interesting number? 30 be? I don't know the density and the economics. So could you give some?
I mean, over a period of time, it's too early. Over a period of time, you like an average franchise a month.
Right. One broader question, the last one from my side, would be in terms of adjacencies that you can get into to increase. For example, I'm looking at Spinny's acquisition of Scooters. Would something like that be of interest? Your current thoughts on what adjacencies you are creating? Scooters, the online diagnostics, services that the entity that they acquired, in Pune.
So what we've looked at in our consumer group business or in all our businesses, again, as I said, we've got strengths on one of our customers, the data, the technology, the product. We are continuously looking out for investments or acquisitions. But these would be in adjacencies. There are 2-3 different adjacencies. So one is, it could be like financing, insurance, it could be around warranties of vehicles, it could be around something with electric vehicles, it could be ownership, which is on car servicing and repairs, or it could be product and tech, which is just around really good products which help our customers, right? But we would not make any acquisition unless it directly benefited our customers, or we had products to offer to their customers. And there's that whole what we call the synergy value. We continue to come, and as I said, a lot of the tech we do build on our own. But if there's something out there which is providing a differentiated experience because of the technology we built, we'd be happy to look at that. And we're looking at those kind of cases.
Right. The reason I ask you this is the frequency of transactions, or rather the frequency of interaction between transactions is fairly long, between one vehicle purchase to the next for an individual. And therefore, I'm just trying to understand how you fill the time gap between two transactions.
Right. Between somebody buying a car today and buying a car after 3-4 years, there's a lot of gap, and that's one of the reasons we continue to look out for something in this whole car ownership space as we talk about, right? On helping them maintain or own a vehicle. It's just that we haven't found something which we think we could invest in, acquire, but we're going to look out for it.
Right. Sure. Thanks so much for the opportunity.
Thank you.
Thank you. We have our next question from the line of Naveen Jain from TN International. Please go ahead.
Yeah. My question is I want to know the full year employee benefit expenses for the full year.
The first quarter was roughly about 4 point. Anything you may want to highlight, but I think, do you mean the ESOP side, or you mean did you mean the salaries? What did you mean?
ESOP sides.
ESOP, right? I thought so. So the ESOP was about 5.3 crores. 5.3 crores in the first quarter. There may be some marginal increase in quarter 2, quarter 3, quarter 4. But Anisha, would you say at the end of the year we should be somewhere about 25 to 30 crores in that range?
Yes, ma'am.
Right.
Okay, thanks. Thanks a lot.
Thank you.
Thank you, Mr. Jain. As there are no further questions, I would now like to hand the conference over to the management team for closing comments. Over to you.
I just want to thank everybody for joining the call. It's been a very eventful quarter for us, and in this quarter we've clearly been able to demonstrate even the growth over the last year same quarter. Also, you've seen with a profitability returning because to the company, which has really been a track record over many years the last 3-4 years. And really thank you again for joining in, and happy at a later date to also clarify any doubts or questions you might have. Thank you, everybody. Thank you.
Thank you. Thank you, everyone.
Thank you.
Thank you. On behalf of CarTrade Tech Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
My pleasure. The conference is no longer being recorded.